Oscar Health is one of the healthcare companies I've had rated as a buy all year long here in 2025, and I'm happy with its performance. It's up almost 22% year to date. Investors are asking me for an update to update this recommendation and let everyone know what I think about this company now. Because the last time I visited the company was a few months ago, and investors want to know, given the company's recent earnings release with a big jump in costs and a decline in profitability, if I still like this company. I'll answer that question in this video. I'll also share with you my proprietary discounted cash flow valuation for Oscar Health, so you can see what I calculated as a fair value for this stock. And of course, I will let you know if I still think it's a buy. Let's jump in.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
Right, so Oscar Health's management team said that we believe the market will stabilize next year and expect to return to profitability in 2026. And Oscar Health made this update on August 6, 2025. So that was reassuring for investors, which saw a big jump in the company's costs, and I'll share that with you a little bit later. Looking on the top line, in the 3 months which ended June 30th, the company's total revenue increased to $2.863 billion, up from $2.2 billion in the same time the prior year. In the 6 months that ended June 30th, revenue jumped to $5.9 billion, up from $4.4 billion. So revenue growth is solid, membership growth is solid. In fact, in the individual and small group membership offering, as of June 30th, 2025, the company boasted 2 million members, just a little over 2 million members, and that was up from 1.5 million members at the same time last year. So a roughly 33% increase in membership. So the membership premiums the company is collecting is increasing. However, the cost to serve these members also jumped more than expected. So the management team attributed the increase in revenue primarily driven by higher membership, but the increase in medical loss ratio, which jumped to 91% compared to 79%, the management team said that this increase was primarily driven by an increase in average market morbidity that resulted in an increase in net risk adjustment transfer accrual, so an increase in cost. This is a non-cash expense though. So to better understand these figures, I wanted to share with you the company's financial statements for the 3 months and the 6 months ended on June 30th. What I have highlighted in red is the increase in costs, and in the yellow are the less significant line items for the company's performance. Operating expenses, medical, jumped to $2.552 billion, up from $1.7 billion in the same quarter last year. So roughly $800 million jump, almost 50% increase in costs, medical costs, to serve these customers. Additionally, for the 6 months ended, you see a similar increase to $4.8 billion, up from $3.3 billion, a roughly $1.5 billion increase, or almost 50% in the 6 months ended June 30th as well. And as I shared with you earlier, revenue was up to $2.8 billion, $2.863 billion to be precise, up from $2.2 billion, but not anywhere near the level that the cost increase. So the cost increase on an absolute basis was over $800 million, and the revenue increase was a little over $600 million. So the cost increases outpaced revenue increases, which led to a decline in profitability. And you see that here on the bottom line. Total operating expenses jumped from $2.1 billion up to $3.1 billion, which led to a loss from operations of $230 million compared to a profit of $67 or $68 million in the same quarter last year. So that was the primary reason why the company's profitability declined. But as you saw in the first paragraph, the management team said they believe these trends will normalize in 2026 and the company will return to profitability in 2026. So that was reassuring to hear from the company's management team that these were a one-off increase in costs and the company expects things to normalize next year. This reminds me of the situation United Health found itself in this year, where it underestimated costs by an estimated $6.5 billion, which led to the company to forecast a huge decrease in profitability this year. But United Health's management team doesn't expect things to normalize. Well, it expects things to improve over the next few years, but it doesn't expect things to normalize immediately, instantly next year. So the healthcare industry overall experiencing higher costs as patients are visiting their doctors more frequently. And when they are visiting, they're needing more severe treatments, which is costing the healthcare industry more than it anticipated going into this year. And I hypothesized that one of the reasons for this is because of how many treatments were put off during the pandemic in 2020, 2021, and in some degree 2022. Folks put off any non-urgent visits to their caretakers because they didn't want to go into doctor's offices. It was a lot more inconvenient. They weren't allowed to bring guests with them. So you can imagine a lot of older folks that go to doctor's offices need assistance, right? Their kids are probably taking them in some cases. And there was a lot of rules with who can go inside and who cannot go inside. And all of these disruptions to the healthcare industry during the pandemic, which led to these unprecedented circumstances, which made it more difficult to manage these kinds of businesses. And health insurers, I think, mispriced a lot of their premiums here in 2025 and underestimated the cost because of some unprecedented circumstances in 2020, 2021, and 2022. And we're starting to see the results of those changes in people's behavior as it relates to healthcare and healthcare treatments. But the good news for Oscar Health stock investors is the management team expects things to normalize next year. So let me share with you my proprietary discounted cash flow valuation model for Oscar Health, which I just updated today. I updated the 2026 free cash flow expectation. I was previously forecasting a positive year in free cash flow in 2026 for Oscar Health. I changed that down here to 270 million negative as I evaluated some Wall Street analysts who revised their estimates lower significantly, and I see the company's negative in earnings as a result of the higher costs. So I revised these 2026 free cash flows lower. 2027 was revised higher by 40 million, and then some minor adjustments elsewhere in the free cash flow expectations. Overall, that resulted in my intrinsic value calculation decreasing by about 10%. I previously calculated the fair value of this stock at around $40 a share. I now calculate it to be around $36 a share. But still, compared to the current market price of $16.45, I still see this company as being undervalued. So to update my recommendation for Oscar Health, I still think this stock is a buy despite these higher costs and despite the already 20% increase year to date here in 2025.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.